Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back to this episode of Financial Planner. Only in the last episode was when we were discussing different products that are available in the secondary market, various equity and debt options that you can avail as an investor. Now let's understand the procedural issues. Once you invest, what happens when you get the shares, when you get the money? Some basic questions that perhaps will be there in the minds of a lot of investors who are wanting to have a taste of equity markets. And to help us understand, yet again we have Jayant Pai with us. Jayant, once again, thank you so much for joining us. Well, everybody not just fears that, equity market is something where you will burn your fingers. You don't know where the markets are going. It's probably run by speculators. This is one part of, what people fear and, sort of stay away from the markets. The other part is that they don't understand how really the transactions happen. So we thought that it's important, then let's deal with it, with the understanding the transaction process with you. Now, we've discussed how you need to get into entering into markets in terms of having a demat account, your PAN card is important, etc. Now let's get into transactions. So once, say for example, you've told your broker that I want to invest or buy these particular shares or amount of shares for me, then there is something called the rolling settlement, which essentially gives the sense of how are you settling the trade. Is that correct?
Yes, actually rolling settlement is a term which is, I'll just dwell on a bit on what used to happen earlier.
Sure.
Earlier settlements used to be for 5 days at a stretch. So on the BSE, the settlement used to begin on Monday and end on a Friday. And all trades which happened within that settlement were netted off. For example, if I bought 100 shares of ACC on a Monday and I sold those 100 shares on a Thursday, so net I had only had to pay or receive the difference. Now unlike that, in today's times, each day is regarded as a different settlement. So and each day, whatever trades are outstanding at the end of that day, they will have to be settled in by giving delivery or taking delivery. So that's why we call it a rolling settlement. So it's not like the earlier days. So the leeway for speculators has reduced a lot today.
Okay.
At the same time, markets have become much safer because formerly people used to tot up huge positions and the counterparty risk used to be high. Today that's not so. Today we follow a regime known as a T+2.
Okay.
Where T refers to the day of the transaction and it is settled 2 days hence. But even though it's settled 2 days hence, whatever is outstanding today has to be delivered. For instance, if it's a Monday and you buy say 100 shares of Reliance, okay, so even if you sell the shares tomorrow, you cannot net it off. You have to actually, the buyer has to pay the money for 100 shares, the seller has to give 100 shares to the exchange, and on Tuesday whenever the sale or when the sale happens, they can reverse it, but it cannot be netted off. So that is the difference.
Okay, if I understand correctly, so say suppose I have invested, as you said, 100 rupees in Reliance shares today. Invested as in I bought 100 Reliance shares.
Okay.
It comes into my demat account today?
No, it will come on the
Wednesday.
On the Wednesday, yeah.
And the person who is sold will get the money in his bank account also on Wednesday.
Yes.
In simple words.
Yeah.
That is how the it's the T+2, which is like you may punch the keys today as far as the buy and a sell is concerned, but the exact transaction, the cash going and the stock coming in will happen on a Wednesday.
Yeah.
Okay. As far as pay-in day and payout day is concerned, is that what Wednesday is in the context that we are talking about?
Yeah.
So essentially your transaction day will be counted as Monday.
Yeah.
Your delivery or sort of the transfer of shares and money will be on Wednesday. And as far as when you're calculating, last week we discussed, or last episode we discussed about the transaction tax, etc. That is all sort of calculated in the price of Monday.
Yes. Whenever you purchase or sell, at that rate everything is based on that.
Okay. Now, as far as another question is that what is a normal settlement in terms of, as the question comes in, that what are prescribed pay and payout days for a normal settlement procedure, which is T+2?
Yeah, so as I said earlier, if we do it on a Monday, so Wednesday is the pay in and payout day.
Okay.
formerly when we used to have physical settlements, before electronic settlements began, the entire process was very tedious. So we used to have a separate day for a pay-in and a separate day for a payout.
Okay.
But today that is redundant because everything happens so smoothly and quickly that the pay-in usually is over by around 10:30 a.m. On X day, and by around 1 p.m. either the money is given out or the shares are given out. So both pay-in and payout happen on the same day nowadays instead of being stretched over 2 different days.
Okay. Jayant, another thing that I want to understand from you is that there is a broker also in between. So you have your stock exchange where you are taking the cues in terms of trading.
Yeah.
Okay. You have your stock broker. So basically when you tell your stock broker that I want X particular shares, he does the transaction. What is the time that you pay your stock broker for the shares that you're purchasing? How does that cycle work?
Yeah, again there are 2 different ways in which this happens. For example, if it's an offline account, that is in the earlier days where you used to call up the broker and broker used to trade on our behalf. There usually brokers allow us a leeway of 1 day. So for instance, if I buy it on Monday, by Tuesday the money should be there in the broker's account so that the broker can aggregate the amounts of various clients and hand it over to the exchange on the pay-in day.
Okay.
If that does not happen, the broker has to fund the difference.
Okay.
In online trading, things are even tighter because usually brokers do not permit us to even place the order without the money being in the account.
Okay.
Or they'll ask for a very large percentage, say maybe 80 to 90% of the money should be in, and you only pay the difference once you actually transact. So.
Same, now let's reverse. When a particular person is selling the shares, what is the time period that he has to give the shares to the broker or make his shares available so that it finally settles? It's also Tuesday in this case? It's
very similar, yeah, because if it's an offline trade where you call the broker and the broker actually transacts on your behalf, he will expect the shares in his demat account by Tuesday. If you sell it on a Monday, by Tuesday it should be there. In online, usually transactions are not accepted. The sale order will not be accepted unless the shares are already there in a demat account. And then you give the broker a power of attorney and the broker will swipe the shares from your account on a Tuesday.
Is there a provision or an option when it can be faster than T+2? No.
There is no such provision, but in order to facilitate clients, brokers have started a facility known as a BTST, that is buy today, sell tomorrow, which they allow for certain liquid shares, usually shares which are part of the Nifty or the Sensex. So here what happens, like how we mentioned earlier, that if I buy 100 shares of Reliance today, technically I cannot sell it tomorrow because the shares have not yet come into my demat account. But brokers, very liquid companies, shares where they have a stock of such companies, brokers allow it as a facility to clients. They extend this facility. So they will say that, okay, you bought 100 shares, I will permit you to sell say 60 shares of this tomorrow and I will deliver on your behalf. When the shares come into your account on a Wednesday, I will keep that 60 with me. So it's an informal stock lending mechanism.
Okay. On that note, Jayant, we've come to the end of the transaction process and therefore we'll have to take a short break here. But do not go anywhere. Your portfolio queries will be answered by Jayant in just a bit.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back to Financial Planner. It's that time when we will be taking your portfolio related queries.
Investment Ladder, presented by the Bombay Stock Exchange, IPF.
Well, Jayant, we have a query from Jevika in Bhaskaran, whose husband has just joined an IT firm in Dubai. His monthly income in dirhams is about 10,000 and he might have expenses of about 4,000 dirhams is what Jevika says. He wants to know what kind of investment he can do in India and how with minimum charges on currency conversion. That is as far as NRIs going out and looking at investment, that's always been an important areas where they are allowed, what they are allowed, how are the conversions happening, and so on and so forth. So let's go across and hear from you. What are your suggestions?
Okay, let's get to the second part first regarding the conversions. So today RBI is far more liberal than what it was say 20 years back. So some of the means in which you can get money into the country are through money changers like Western Union. There are also many banks. Now Indian banks also having a presence abroad. So in Dubai there is Bank of Baroda and State Bank and even ICICI, HDFC. All these banks are there. You could use their channels to remit money here. In fact, if you use a common bank, for instance, if Jivika has an account in say ICICI Bank, so her husband can use the ICICI Bank channel, so he'll save some money there. Plus there is another mode which the post office offers. It's called MO Videsh, that is Money Order Videsh.
Okay.
Wherein they will allow you to remit a certain amount. Like there are certain ceilings on that, but this falls within that. This is around 70,000 a month because he's saving 6,000.
Yeah.
So at the current rate of around 12 rupees, it comes to 72,000. So even if the full thing is remitted, it is permissible. So I believe that is the cheapest method right now. Although the charges are not been specified by the post office on their website, but I think Jivika could explore this. Otherwise, there is a transfer mode known as MT103, which it's a term used for a certain mode of money transfer, wherein banks do it using the SWIFT mechanism. But if he approaches any of these banks, it's a very common term. That's very economical for certain amounts which are around say at least 2-3,000 US dollars. So I don't know for this amount how much it will be, but that's one more thing he can explore. Okay, now once the money comes in, then what is to be done? Because I think around 72,000 will come in every month. So if they do not require this money for a period of 5 to 6 years from now, then I suggest that every time the money comes in, Jivika invests this amount into 3 good equity diversified funds.
Okay.
Okay, so I mean there are some names which DSP Top 100 or say Fidelity, ICICI Dynamic, Franklin Prima Plus. The names are not that important. Main thing is the
way of
the
doing
process
it
and the discipline.
Yes, yes.
So that is one thing, because otherwise the money will languish in the savings account. So that is one thing. In case they require money for within a shorter time period, say within next 3 to 4 years, then I suggest that part of this money, say half this amount, say 36,000, could be invested through a monthly SIP in a good debt-oriented balanced fund. These invest around 75 to 80% in debt and balance in equity. So they'll get a flavor of equity, without putting a lot of capital at risk. So half could be done there, and second half could be into a recurring deposit of any bank, which currently you are getting around 8.5 to 9%.
Okay.
So
one thing that I'd like to ask, and may not be specific to Jivika's case here, but there is an option, and having done couple of currency related shows, when they're talking about having hedging through currency exchanges, that has been suggested that or at least some experts do suggest that when you're looking at remittances coming in, it could be a good option for not just SMEs or industries, but also for retail investors. I want to hear your thoughts on it. And I understand that dirhams etc. are not, there are very few currencies that are listed, but over and above that, if one is looking at general who's sending remittances etc., how important or critical that avenue should be?
Yeah, that could be, because you got to just have a trading account with one of the members of the currency markets. NSE offers contracts of minimum $1,000. So for around 40 to 50,000 rupees, even if your remittances are for that small amount, you could use this this mechanism. In fact, it's quite cost effective. So it's something which was not available earlier, but it's good you mentioned this. So currently it's there in 4 currencies only, in dollars, pounds, euros and yen. But I think the bouquet will expand.
Okay. Well, Jivika, as Jen just informed you, as far as outlined the entire ways of how the entire remittances, etc., can be worked upon, he's advised that it is better that if you have similar accounts. Nowadays, most of the banks do have their branches in Dubai and other areas, so it would be beneficial if you could look at having a same account in the same bank, so to say. And also, as far as your investments are concerned, the advice coming from Jayant is that you should look at an SIP, which is a systematic investment plan, looking at equities, constantly investing in them for a longer period of time, unless you have a requirement in a short term. In that case, you could look at some balanced fund. He's already outlined some of the names that he thinks are good funds. So these are the options that you have and you could perhaps consider.
Investment Ladder, presented by the Bombay Stock Exchange, IPF.
Well, on that note, we take a short break, but we'll be busting some terms in just a bit.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back to Financial Planner. It's that time that we bust some terms, and the term that we have chosen today is auction market. Not a simple term, but we'll go step by step, and it is different for different markets, right?
Yeah. But
so, what is an auction market?
The basic principle remains the same, like in any auctions, whether it's an art auction or anyone, and there will be a group of people bidding for a certain asset, and whoever puts in the highest bid usually gets the asset.
So how does it work in an equity market? Because you have investors all across the world, and how does it work in that sense? Let's go simply and explain.
Yeah, actually the equity market can be used both to explain it and also to explain the exception.
Okay.
So, for instance, an equity market, there are two parties, the buyer and the seller. Both, once they enter into a contract, that is when the buyer purchases something from the seller, both the parties are supposed to adhere to the contract. They cannot renege on it. But it may happen that sometimes one side is unable to fulfill their part of the obligation. So, for instance, if the seller is unable to deliver the shares on the pay-in day, okay, then what happens? Then does it mean that the buyer has to look somewhere else? Actually, this task is done by the exchange on behalf of the buyer. Okay. So the exchange will conduct something known as the buy-in auction, wherein the shares which have not been delivered will be placed on auction.
Okay.
And people will bid to offer their shares.
Okay.
Only thing is, this is the exception, because here the shares which are offered at the lowest rate, they are accepted, not the highest rate.
Okay.
Okay, so the shares which are offered lowest, for instance, if there are 100 shares of Reliance and somebody offers to sell it at 845, and there's another one who offers at 844. So that way the lowest at the end of the auction, only their shares will be accepted. Those shares will be given to the buyer. So the buyer is happy. So buyer is not concerned where the shares are coming from. But what about the seller? So the seller, suppose, has sold the shares for only 820, but the auction rate is 844. That balance 24 rupees into 100, that loss has to be borne by the seller, as a penalty for not delivering on time.
It's the seller who's at loss in terms of the auction market, in terms of paying the default or price for the default, right?
Yes, that is if the seller has not delivered. But in the opposite case, where the buyer does not pay up on time, so where the seller has delivered to the exchange but the buyer does not pay up, then the buyer has to suffer. So then we conduct a normal auction, by which again there's a bidding for the shares, and the highest bidder wins. Then again the difference between what the buyer has purchased and what the auction happens, that difference is borne by the buyer. Yeah.
Okay. Now, as far as there are different categories in terms of the equity, which you have explained very extensively right now. As far as the other side of auction market, where say for government securities, how does that work?
That also, it's a congregation of players, but here the players are mostly institutions. It can be banks, debt mutual funds, or there are these entities known as primary dealers. So they will come together and they will participate in the auction for government securities. Now these government securities are auctioned as per a predetermined calendar. The Reserve Bank comes out with this calendar at the beginning of, say, 6 months, every 6 months. In fact, this calendar is very keenly watched as a signal for where the interest rates may go. Because if there is a huge borrowing calendar, the participants, they infer that rates may go higher. Now again, there are two types of securities here. One is the dated securities, one is the T-bills. Now dated securities are coupon securities, where the face value is 100. Now the auction rates will be based on what the prevailing market rates are. So for instance, today when we are in a high rate regime, people will want to pay less than 100 rupees for every 100 rupees face value debt security, because they want to make up. For example, the coupon rate is say 7%, but the prevailing rates are 8.5%. So the participants will bid around 94, 95 to make up, so that they get an equivalent of what the prevailing rates are.
Prevailing rates are,
yes.
essentially.
Also in case of T-bills, T-bills are discounted securities. There is no coupon payment, where suppose the T-bills mature in 1 year. The face value will be 100, but today they will be given at a rate less than 100. For instance, if it is given at 92, so then we know that whoever buys it, they will get 8% yield. So that's the difference.
Well, on that note, we've absolutely run out of time, Jayant. Thank you so much for guiding us and taking us step by step in understanding. Well, thank you for you to join us on Financial Planner, and we'll be continuing to guide you all through as far as your process of investing or getting into equity market is concerned. Thank you for watching.